Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding the P/E ratio, essential insights for smart investing. Ever wondered how investors decide if a stock is worth the gamble? Enter the P/E ratio. This straightforward metric provides a window into whether a stock is overpriced or a bargain. The P/E ratio, or price-to-earnings ratio, is key to assessing a company's market value in relation to its earnings. It's the financial tool that helps investors separate shining gems from fool's gold. In this article, you'll learn the basics of P/E ratios, why they matter, and how they can guide your next big investment decision. Get ready to enhance your investing savvy with insights that could reshape the way you view stock opportunities. What is the P/E ratio? The P/E ratio, or price-to-earnings ratio, acts like a compass for investors. It points to a stock's valuation by comparing its current share price to its earnings per share, EPS. This ratio helps investors figure out whether they're looking at a good deal or something that's overpriced. But what exactly goes into this calculation, and what are its different forms? Let's break it down. Formula for calculating P/E ratio. Before diving into the types of P/E ratios, it's essential to understand how it's calculated. The formula is simple yet powerful. P/E ratio equals price per share, earnings per share, EPS. Price per share. This is the current market price of a single share of the company's stock. It reflects what investors are currently willing to pay for each share. Earnings per share, EPS. EPS is a measure of a company's profitability and is calculated by dividing the company's net earnings by the number of outstanding shares. Think of it as a snapshot of how much profit the company is making for each share you own. By dividing these two figures, the P/E ratio offers a quick look at how the market values the company's earnings. Types of P/E ratios. Knowing that not all P/E ratios are created equal is crucial for any investor. There are several types of P/E ratios, each providing a different lens through which to view a company's financial health. Trailing P/E. The trailing P/E focuses on past performance. It utilizes earnings information from the previous 12 months. This makes it a reliable indicator based on actual, historical data. However, one downside is that it may not reflect current market conditions or future expectations. Forward P/E. The forward P/E, also known as the projected P/E, looks ahead. It uses forecasted earnings for the next 12 months. This can be particularly helpful if you want to invest based on where you think the company is headed. But remember, forecasts can be optimistic and may not always be accurate. Normalized P/E. The normalized P/E adjusts earnings to smooth out fluctuations caused by unusual events, like economic downturns or one-time gains. This offers a more stable, long-term view of a company's earnings capabilities. It can be helpful to see past temporary market noise, but it requires more in-depth analysis and understanding of the company's operations. In essence, understanding the P/E ratio, its formula, and the variations can help you make informed investment choices. Whether you're looking backward, forwards, or normalizing your view, each type of P/E ratio provides valuable insights for your investment journey. Importance of the P/E ratio in investing. The P/E ratio isn't just a number. It's a peek into a company's potential and an investor's guide to deciding whether a stock is too pricey or a hidden treasure. By understanding its implications, you can craft a more strategic approach to investing. Valuation measurement. A pivotal aspect of the P/E ratio is its role in determining a stock's value. It serves as a barometer of whether a stock is overvalued or undervalued. Overvalued stocks. If a company's P/E ratio is higher than the industry average, the stock might be overpriced. This could imply that investors are paying more per dollar of earnings, possibly due to the company's high growth expectations or market hype. Undervalued stocks. Conversely, a low P/E ratio might suggest that a stock is undervalued. This could be a signal for potential investors to consider the stock as a bargain if the company's fundamentals are solid. In short, a keen eye on the P/E ratio can help avoid the trap of overpaying, or it could spotlight a stock with promising returns. Comparative analysis. Comparing apples to apples is crucial in investing. The P/E ratio shines in comparative analysis, especially within the same industry. Industry benchmarks. By evaluating P/E ratios of firms in the same sector, investors can gauge which companies are trading at more attractive valuations. Identifying leaders. A company with a significantly lower P/E might be underappreciated compared to its peers, potentially indicating an opportunity for growth or a hidden gem waiting to be discovered. Such comparisons help investors pinpoint where each company stands in the competitive field, assisting in making educated choices about which stocks to buy or avoid. Performance indicator. The P/E ratio also serves as a forecast for a company's future performance and growth prospects. Growth expectations. A high P/E can often signal that investors anticipate higher growth from the company, reflecting optimism in its future expansion and earnings potential. Market sentiment. Conversely, a low P/E might indicate investor skepticism about future earnings growth, which may not always be justified. It could be an opportunity if the market misjudges the company's trajectory. Ultimately, the P/E ratio isn't just a static number, it's a dynamic indicator of market sentiment and future expectations. Understanding its implications can arm investors with insights to navigate the stock market wisely, seeking out opportunities and avoiding pitfalls. Interpreting the P/E ratio. Understanding the P/E ratio is crucial for making informed investment decisions. This metric, while simple on the surface, reveals much about a company's position and market perception. Let's explore what different P/E ratios can truly signify. High P/E ratios. A high P/E ratio often sparks curiosity. Is the company overvalued, or is there more to the story? A high P/E ratio usually indicates that investors expect significant growth from the company. They're betting on future earnings potential, believing that the company will deliver and justify the higher price tag. Think of it like paying a premium for a high-end brand. Investors think the brand's reputation and prospects justify the cost. However, it's essential to look deeper. Sometimes, a soaring P/E may result from speculative market trends or hype, where the price exceeds the company's actual performance. Investors need to assess whether the expectations underpinning this high P/E are realistic or simply inflated hopes. Low P/E ratios. On the flip side, a low P/E ratio might raise eyebrows for different reasons. Does it signal a bargain or a struggling company? A lower P/E often implies that the market has subdued expectations for the company's future earnings. This can make a stock seem cheap, presenting an attractive buy opportunity if the fundamentals support it. But beware of the trap. A low P/E may indicate underlying issues, such as declining revenues or industry challenges that could limit growth. It's like seeing a sale sign in the window. Sometimes there's a good reason items are marked down. Analyze whether the discount reflects a temporary setback or an ongoing problem. Industry context. Interpreting P/E ratios without considering the industry context can be misleading. Different sectors have unique characteristics and growth potentials, which influence typical P/E ranges. For instance, tech companies often showcase higher P/E ratios due to expected rapid innovation and growth, whereas utility companies might have steadier, lower P/E ratios due to predictable earnings. To make sense of a company's P/E, compare it to the industry average. This helps determine whether the company is outperforming its peers or lagging. Think of it as benchmarking a race. A sprinter's speed is impressive until you see how they rank among other sprinters. When evaluating P/E ratios, always keep the broader industry picture in mind to understand where a company truly stands. Limitations of the P/E ratio. The P/E ratio is a valuable tool for investors, but it has its share of limitations. It's not always the magic key to unlock investment wisdom. In this section, we'll highlight some of these common pitfalls. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.